Benjamin Graham once said that in the short run, the stock market is a voting machine, but in the long run, it's a weighing machine. Decades later, that single idea still sparks one of the biggest debates in investing. Has the father of value investing been proven right, or has the modern market left his playbook behind? The answer might change the way you invest forever. Benjamin Graham built his philosophy during a time when information traveled slowly, emotions ruled the market, and bargains were hiding in plain sight. His approach was simple but powerful. Buy great value for less than it's worth, insist on a margin of safety, and let patience do the heavy lifting. It wasn't glamorous, but it worked. One of his most famous students, Warren Buffett, used these principles to build one of the greatest investment records in history. But today's market looks very different. Artificial intelligence can analyze financial statements in seconds. Millions of investors have instant access to company data. Index funds and ETFs dominate retirement portfolios. High-frequency trading executes thousands of trades before most people finish reading a headline. So, does Graham's strategy still stand a chance? The surprising answer is yes, but not in the way many people think. Modern investors often chase the next big thing, whether it's artificial intelligence, electric vehicles, or the latest technology stock. Graham would likely ask a different question. Instead of asking, how exciting is this company, he would ask, what is it actually worth? And am I paying too much? That shift in thinking is timeless. Markets evolve, industries change, and technology advances, but human psychology barely changes. Fear still drives people to sell at the worst possible time. Greed still convinces people that prices can only go higher. The emotions Graham observed nearly a century ago are still moving markets today. However, modern investing has expanded beyond Graham's original framework. Today's greatest businesses often derive enormous value from software, intellectual property, network effects, and brand loyalty, assets that rarely appeared on balance sheets in Graham's era. Companies like Apple, Microsoft, and Nvidia demonstrate that exceptional businesses can remain expensive by traditional value metrics while continuing to create extraordinary shareholder wealth. This is where modern investing builds on Graham instead of replacing him. Investors like Charlie Munger encouraged Buffett to move beyond buying merely cheap companies towards buying outstanding businesses at reasonable prices. The margin of safety remained, but the definition of value became broader. Perhaps Graham's greatest lesson wasn't ever about finding low-price stocks. It was about developing emotional discipline. He believed successful investing depends less on intelligence than on temperament. The investor who stays rational while others panic often gains the greatest advantage. So Benjamin Graham versus modern investing isn't really a battle. It's an evolution. The tools have changed, the markets have changed, the companies have changed. But the principles of patience, discipline, independent thinking, and paying less than something is truly worth remain as relevant today as ever. In the end, the smartest investors don't choose between Benjamin Graham and modern investing. They combine Graham's timeless wisdom with today's opportunities, proving that while markets evolve, great investing principles never go out of style.